Welcome. I'm Nicole Cervi, and I'm joined here today by my colleague Sarah House to discuss recent changes in our economic outlook. So Sarah, we haven't materially changed the contours of our forecast since our last update. So why don't we go ahead and start out our conversation, discuss how the data has just evolved since the last time that we wrote our economic outlook.
Sure. So generally it's come in still much better than expected. So you can see that in terms of, for example, the Bloomberg Economic Surprise Index is hovering around its highest levels in 2.5 years. Now, I think probably the most notable area where we continue to see stronger than anticipated data has come from the housing sector. So we've seen mortgage rates trend up over the past few months, and they're back above 6.5%. But that's created a dearth of existing home inventories where a lot of homeowners who have mortgage rates significantly lower than where they are today, they don't want to move. And so that low inventory has helped support prices and also homeowners' equity. But it's also given builders confidence to step back in and ramp up single-family construction. So we've actually seen single-family permitting increase every month this year, and it's up about 20% year to date. Now, we've seen in terms of the labor market data, it's cooled a little bit. So we saw the non-farm payroll numbers come in slower, but at 209,000, that's still comfortably above the average that we saw over the last cycle. And when we step back and you look at the total labor market, it's still incredibly strong right now. So we saw that with the unemployment rate ticking back down to 3.6%. So that's keeping it within that pretty narrow range of 3.4 to 3.7% we've seen since March of last year. And we even saw it pop back up in terms of average hourly earnings. So when you look across different wage and labor cost measures, you're still seeing those labor costs grow comfortably above 4%. So still indicating a very tight jobs market. So Nicole, what about the consumer? How is the consumer doing of late?
So consumer spending actually came into the year quite strong. It rose at a 4.2 annualized pace in the first quarter. But in more recent months, consumer spending has started to moderate. And looking ahead, we actually expect real PCE to be slow in the coming quarters. What's driving that is consumers, their capacity to spend has started to thin. Real excess savings that they've stockpiled during the pandemic has thinned materially. And then at the same time, access to credit has tightened significantly. So in terms of the income side, we look for real disposable income growth to slow in the coming quarters as well. That stems from softness in the labor market as less jobs are getting added, less labor income, and then a less marked improvement in inflation. So on that note, Sarah, could you talk to us a little bit more about our outlook for inflation and what we're expecting there?
Sure. So I think we are seeing clear signs of disinflation. So we saw with the June CPI data that year-over-year price growth slowed to just 3%. So big improvement from over the past 12 months when we were looking at inflation of over 9%. And we're also seeing some improvement in the core. So we actually saw the smallest monthly increase in the core CPI in June since early 2021, and that pushed the year-over-year rate back below 5%. And really what's driving that is we are starting to see some of these pandemic distortions unwind. So we're seeing goods disinflation resume. We're also seeing the other side of the housing flurry and the travel flurry that we saw coming out of lockdowns. And so prices there are disinflating as well. And so that's leading us to expect, along with that more squeezed consumer, which you mentioned, to expect inflation to continue to slow. I think particularly we'll see that in the core index. But overall, we're still thinking that a sustained return to 2% is still some time away. So we've seen commodity prices have been more or less stable in recent months. We don't have quite that same degree of a tailwind to disinflation that we have seen over the past year. So still some work to do on the inflation front.
Got it. So like you said, core inflation has actually come down below 5%, which is a positive development, but that's still more than double the Fed's 2% inflation goal. So the Fed has a meeting coming up in a few weeks here. So what do you expect them to do at their July meeting?
Right, so I think we certainly saw some encouraging news on the inflation front, but when we look at where the FOMC is right now as a committee, so I think there's pretty broad agreement that inflation is slowing, but there's less agreement about whether the current policy setting is enough to get inflation back down to that 2% target for the long haul. So we saw in the June meeting, they chose not to raise rates, but they did strongly signal that more rate hikes were to come. In fact, we saw the median expectation for where rates would end this year moved up by 50 basis points. So we think we'll see that message followed through with another 25 basis point hike at the upcoming July meeting. But in our view, that's likely to be the last of this cycle, as we do think that the downshift in core inflation that we saw in the June data, I think, can be maintained. And then I think just you are starting to see more policy makers weary about the potential for overdoing it. So we think that after this next 25 basis point hike, that the FOMC settles in for an extended pause.
Well, thank you for joining me today, Sarah. And from all of us at Wells Fargo, thank you for tuning in to our latest economic outlook.